Hey, Dividend investors, Jeremy here from Dividend Stock Pal. Had some exciting news today I wanted to share with everyone. Amplify ETFs just released a new ETF. It's a high dividend ETF called QDVO. So in this ad hoc video, I wanted to talk through what the ETF is all about, what they're going to be doing with it, and some of the opportunities that I see with this particular fund. So let's get started. So as you see here on your screen, I'm on the Amplify ETFs website. And they're the owners of many different types of income ETFs. As you see here on the screen, they're the same company that does the very popular DIVO, DIVO, and IDVO, the CWP International Enhanced Dividend Income ETF, along with a bunch of other great ETFs, both for income and thematic and core. So the new one that we're talking about today is the QDVO, the CWP Growth and Income ETF. This is run by the same portfolio manager as DIVO and IDVO, but it has a different focus. So I'm extremely excited about this particular product. I actually purchased some this morning already, and I can't wait to see how this one performs. So let's dig into what this one's all about. Going to the QDVO specific site, as you see here, it just launched today, August 22nd, this morning. So why invest in QDVO? So you get growth and high income potential at the same time. So what this particular ETF focuses on is the growth-oriented stocks. And they also get a high monthly income from the options, premiums, and dividends of the underlying holdings. So the great thing about all of the DVO type of products like DIVO and IDVO and QDVO is they do a mixture of dividend-focused companies. That's one of their main sticking points, is it has to pay a dividend, and also writing covered calls selectively on specific holdings. They're not going to do the entire index like QYLD or any of those other types. They're going to be very selective, and it's going to be an active approach to the covered call writing strategies. And the point of that is to provide additional yield and additional income while still being very conservative and allowing the upside. So it is an active manager. CWP is the organization that runs it, and that's run by Kevin Simpson. In my opinion, one of the best dividend and options related portfolio managers out there. If you haven't seen it already, Kevin has a wonderful book. Hope you can see that. Walk Towards Wealth. It's a fantastic book. I read through it all. I'm going to put a Amazon affiliate link in the description. If you want to pick it up, it'd be a big help. No extra cost to you, and it would help out the channel. But Kevin Simpson is an amazing portfolio manager and a avid dividend investor, as well as focused on covered calls. So let's look more into the objective and the strategy of QDVO. So it says the Amplify CWP Growth and Income ETF is an actively managed ETF seeking to provide capital appreciation and secondarily high current income. It consists primarily of large cap dividend growth stocks and is designed to offer high levels of total return on a risk adjusted basis. So because this fund just started today, it's not going to list out the yield or anything like that, but we'll talk about what the expectations are in just a little bit. It started trading today at $25 and it is currently at around the same price. Let's look at some of the top holdings, and we'll go into more details with the holdings in a second. But I mean, the top 10, you can't beat these names right now. Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, Tesla, Broadcom, Netflix, United Health Group. Anyone would be happy to hold these. And the great thing about this particular product is it doesn't write cover calls on all the positions, so you still can get a lot of the upside of just holding these names individually. And then there's going to be a selective cover call strategy, given the right time and the right atmosphere of where it makes sense as a conservative approach to gain a little bit more yield. So how do they do their methodology? First, they start with growth equities, a portfolio of large cap growth equities with historically strong earnings and cash flow characteristics. And they're going to balance those on around the portfolio based on the GICS sectors, which we'll talk about in a second. And then the portfolio is going to be pretty concentrated. It's only going to focus on 20 to 40 stocks, which are screened by the manager and included based on the attributes that they believe are attractive, including earnings growth, cash flow, relative performance, and management track record. On top of all that, they're going to do a cover call option strategy on individual stocks on a tactical basis. That's what I was talking about earlier. So you get the situation where if a cover call makes sense based on the outlook in the short term, they can write a call on that to gain additional income, or they can leave it unwritten and you just get the capital appreciation. Some sector allocation as of today, you see the information technology is the highest percentage at 43.52, followed by consumer staples at just under 18%. You have consumer discretionary at just under 12%, and healthcare at 8%. But as you see, it has a wide variety of different holdings and different sectors to balance out the portfolio. And again, because it's brand new, it just started today, there's no performance history. But if you look at the other ETFs that they manage, DIVO and IDVO, they've produced excellent results. So I have no worry that this one won't perform very well as well, and maybe even provide a higher yield than the other ones because it is focusing more on the growth names. So with that said, let's look at some more of the names on this particular account. All right, so we talked about the top 10 or so, but also has Lockheed Martin, Procter & Gamble, Colgate, Allstate, T-Mobile, Iron Mountain. These are all high quality dividend names that most of us would love to have in our account as it is, but also put some of the growth in there as well. We have Palantir, Spotify, there's Intuitive Surgical. These are the growth names that we're looking for that capital appreciation over time, but they still do collect a dividend as needed. I wanted to go to the prospectus and look at the expected yield. So between the individual holdings, looking for capital appreciation, plus the dividends, plus the cover calls, CWP expects a gross income of approximately 0 to 2% from the dividend income and 4 to 6% from the option premium, plus the potential capital appreciation. So looking at this, you're going to be looking between a 4 and an 8% yield based on the current market conditions and how much options premium they can receive. What this particular fund is going to focus on, though, is the options premium. Because these are higher growth names, they have higher volatility. So the premiums that you receive from sell and cover call options will be where the majority is. As opposed to some of the other high yield income ETFs you see out here, a 4 to 8% yield is not drastic, and that is on purpose because they are looking for the capital appreciation as well. A lot of the other cover call ETFs out there only look for options, and they're going to sell 100% at the money, but you don't get any of the upside. You only get the downside. With this particular one, you get a little bit of the dividend income, you get a little bit amount of option premium, but it leaves open the portfolio to gain over time in capital appreciation, which if you look at DIVO and IDVO, that's exactly what's happened. So I love the fact that they're continuing the same strategy, but with these higher growth names. Looking at the fact sheet, you can see that it just started today again. It has 38 holdings as of today, and the expense ratio is 0.55. Some people might think that's too high, but remember this is an active fund, and they are doing both security selection as well as option strategies. So paying an expense ratio makes sense. And again, 55.55 is only $55 per every 10,000 invested in a year. So if you really look at the cost compared to the benefit that you're getting of that active management, 0.55 is very reasonable. A lot of the other income ETFs have expense ratios around 1%. So this is very reasonable. As I mentioned before, it's run by Kevin Simpson, which I talked about earlier. He's one of my favorite portfolio managers, and also Josh Smith from Capital Wealth Planning. All right, so we talked about the reasons to invest. We talked about the 10 top holdings. We talked about some of the sector allocation and how they deliver their products. So I'm not going to take up too much of your time. I'm just going to look through a couple more things just to make sure that you have a full understanding of what this fund is all about. Okay, so generally speaking, I love the idea of this fund. I went ahead and purchased some myself this morning. I went ahead and put $1,000 into this fund. I'm looking to increase my allocation to this portfolio over time. Ideally, I'm going to be looking to get this about a 3% holding in my portfolio. I said at the beginning, I also have DIVO and IDVO, which are both around 2 to 3% of my portfolio. So this one is a great addition. It focuses on slightly different names, but the strategy is the same. And the results speak for themselves from CWP and Amplify. So hopefully you appreciate this quick overview. You can find this particular ETF on all your major brokerages. You can start in trading today, so you can go out and buy it. Let me know in the comments what you think about this fund, what you think about the other ones, DIVO and IDVO. And if there's any other Amplify ETFs that you're involved in and like. As a community, I'd love to share the information to those who are out there. All right, thanks for joining. I know this was kind of offbeat, off script, but hopefully this gave you insights into this great new fund, and look forward to talking to you the next time. Have a good one, everyone.